All right, today we're jumping into the Q2 2025 earnings for BingX, which you probably know better as FlashX in China. Now, on the surface, the numbers looked pretty rough, but the market told a totally different story. We're going to get into exactly what created this fascinating profit paradox.
So let's get right to the heart of it, because this is the big question. Revenue falls by almost 13% year over year, and it misses what analysts were expecting. I mean, 9 times out of 10, that's a stock that's heading south. But instead, FlashX climbed nearly 4%. So what on earth did the market see that made them want to buy into a company that was, on paper, shrinking?
Well, the answer is actually hiding in plain sight, right inside the earnings snapshot. It's a classic tale of two numbers, where the big, flashy one, revenue, is telling you one thing, but the real story, the important one, is happening somewhere else entirely.
Okay, first, that big, ugly headline number. A nearly 13% drop in revenue. And management was really clear about why. They said, look, the competition out there is just brutal and it's driving our order volume down.
But, and this is the huge but, at the exact same time, their gross margin expanded by 120 basis points. That is a massive signal of incredible discipline. It means they were simply making more profit on every single delivery they made.
And what's the result of that kind of discipline? Well, net income just exploded. We're talking a staggering 140% increase. So the takeaway here is really simple. Yeah, the business got smaller, but man, it got so much more profitable.
Look, this didn't just happen by accident. It wasn't a fluke. This was the direct result of a major strategic pivot. They decided to get off the treadmill of growth at all costs and instead made a very deliberate choice. We're going for quality over quantity.
And this really lays out the whole shift perfectly. You know, the old way, the way the whole industry works, is you fight tooth and nail for every single low-margin order in a totally saturated market. But the FlashX way? They're sidestepping that entire street fight. Instead, they're zeroing in on these high-value, niche markets, where they can offer a genuinely better service and, you guessed it, charge more for it. Management has a name for this whole approach. They call it process engineering. But don't let the corporate jargon fool you. This isn't about building some flashy new app or reinventing the wheel. It's about perfecting the nitty-gritty, the operational playbook for very specific kinds of deliveries. It's innovation focused on how they do the job. So that all sounds great in theory, right? But what does this playbook actually look like when the rubber meets the road? Well, on the earnings call, management gave us some really concrete examples of how they're making it work. Take high-value electronics, laptops, phones, that kind of thing. Delivering them is super risky. If you drop it, it's a huge loss. So to solve this, FlashX created a whole 3-step process. They put their own support staff right on site with the merchants, they work with clients to get the packaging just right, and they give their riders extra training on how to handle these fragile items. And you don't have to take my word for it. The CEO, Adam Shu, laid it out himself on the call. This isn't just about preventing damage. It's about building real trust and confidence with these crucial high-value clients, making them feel like they can't live without this premium service.
And this strategy isn't just for electronics. They're doing the same thing in other delicate categories, like flowers and cakes, where they're already a huge player. They even deploy special on-site teams during big holiday rushes to make sure nothing goes wrong. It's all backed by a huge investment in supporting their riders and even exploring totally new areas, like luggage delivery. Okay, so we've got the strategy. Focus on profitable niches. We see how it works. Now, let's circle all the way back to that first big question. How did Wall Street actually react to all this? And why? The stock closed up almost 4% on earnings day. Pretty good. But here's the really telling detail. Look at the volume. Only 52,000 shares were traded, which is actually less than the 90-day average. What does that tell you? This wasn't some speculative frenzy. It wasn't a short squeeze. This was a quiet, thoughtful reevaluation by investors who dug into the numbers and really liked what they saw.
So at the end of the day, in this tough, competitive market, investors looked at that ugly revenue number and basically shrugged. They decided to reward the things that signal a truly healthy business, expanding margins, actual net income growth, and a really shareholder-friendly move, a new $30 million share buyback. Which brings us to our final section, and my favorite part, the next call. Given this really smart pivot, what's the actual investment thesis as we head into the third quarter?
You can really feel the story starting to change here. FlashX is working hard to shift the conversation from a company with shrinking revenue to a profitable niche leader. So the question for all of us is, how do you trade that? What's the move from here?
Let's break it down. Bull versus bear. The bulls are going to say, hey, these profit margin gains are real and they're here to stay. This niche strategy can get even bigger, and that buyback is going to put a nice floor under the stock price. The bears, on the other hand, are going to say, not so fast. That revenue decline could get even worse. The competition isn't going anywhere, and rising costs could eat away all of these new profits.
So, where do we land? For me, the call is market perform. Look, FlashX has done the hard part. They've proven they can engineer profitability. The key question for Q3, the entire focus, is whether they can now stop the bleeding on the top line. The single most important thing to watch on the next call is order volume. If they can stabilize that number while holding on to these fantastic margins, then the narrative shift is complete. The real question investors need to ask is, have they built a truly durable business, or is this just a temporary shelter from the storm?
And as always, this is not financial advice.